Welcome to the end-of-year economic briefing, where the collision of Federal Reserve policy and a $500 billion AI boom is about to redefine the U.S. financial landscape. This isn't just about reading the headlines, it's about decoding the silent signals the market is sending. 2024 is shaping up to be a year of seismic shifts. Three critical factors are converging right now, and if you're an investor, you need to understand them fully. First, the Federal Reserve is nearing the end of its quantitative tightening program and is preparing for a strategic pivot. This is much more than a simple rate cut. It's a fundamental change in how the central bank manages liquidity. The new phase? It's been dubbed T-bill and chill. We'll break down what that means for your cash holdings. Second, the $500 billion wave of AI spending is creating an economic paradox. It promises massive productivity gains, but it's simultaneously causing a sharp disconnect in the labor market, accelerating the rise of the K-shaped economy and spiking volatility in specific sectors. Is the AI boom a lasting tide or a pending bubble risk? And third, the benchmark 10-year Treasury yield is back below 4%. What is this sudden pullback telling us? Is the bond market signaling an impending economic slowdown, or is it merely getting ahead of the Fed's easing cycle? The stakes are high. As the year closes, there's a serious risk that many investors are overlooking: the possibility of a surprise 50 basis point rate cut from Jerome Powell. We'll analyze why this maneuver is more likely than you think. Stay with us. Let's start with the central bank. The Fed is about to end its QT program, the process of unwinding its massive post-COVID balance sheet by letting assets mature without replacement. This is a crucial checkpoint, perhaps more so than the rate decision itself. The next move is expected to be T-bill and chill. This means that instead of letting all bonds mature, the Fed will start reinvesting, but strategically focusing on short-term Treasury bills, or T-bills. This move is designed to inject more liquidity into the financial system without signaling a return to full-blown quantitative easing. It's a subtle form of easing aimed at keeping the plumbing of the banking system well-oiled. But here is the real head-scratcher: the risk of a 50 basis point rate cut. History shows Fed Chair Powell often moves in short, intense cycles. In past easing cycles, like in 2019, we saw 3 back-to-back 25 basis point cuts followed by a pause. If Powell is set to cut in October and December, he has a defined window for action. Why 50 basis points? Beyond the economic data, there is a legacy element. Powell is operating near the end of his tenure, and if the situation demands a decisive move, a close call between 25 and 50 basis points, he may opt for the larger, more protective cut. It's the safer bet to ensure the economy stabilizes, allowing him to exit on a strong footing. Now, let's turn to the technology story that's become a bond market story: artificial intelligence. Global spending on AI is projected to hit $375 billion this year and skyrocket to $500 billion by 2026. This is a massive capital expenditure wave. For the stock market, AI has been pure adrenaline, but for the bond market, it presents a fascinating asymmetry: a heads you win, tails you still might win scenario. Scenario 1. AI is real. If AI delivers the promised productivity boost, it will accelerate economic growth. But as we've seen with layoffs in the tech sector, this productivity comes at a cost of labor displacement, particularly among younger cohorts, ages 16 to 35. This creates a disconnect: high growth plus high unemployment. The Fed's dual mandate prioritizes labor, forcing them to become more dovish, cutting rates to protect the unemployed even in a growth environment. Result: lower short-term rates, steeper yield curve. Scenario 2 is AI is a bubble. If the lofty valuation's correct and the bubble pops, financial conditions will tighten significantly, leading to a market correction. The Fed's predictable response: cut rates to stabilize the system. Result: lower short-term rates, steeper yield curve. In both the best-case and worst-case scenarios for AI, the likely outcome is the Fed cutting rates. This is why the AI story is directly impacting Treasury yields and is the single biggest driver behind the unsettling phenomenon known as the K-shaped economy, where high-income consumers tied to the stock market thrive, while low- and middle-income workers are left behind. The most crucial metric in the fixed income world right now isn't the 10-year yield's level, but its volatility, the rate of change. High volatility scares the market. Low volatility breeds complacency. The low-rate volatility we've seen recently is partly due to the Fed holding rates steady for months, but it also presents a challenge for bond investors, less trading opportunity, and a push toward consensus positions. The return of the 10-year yield below 4% suggests the market is starting to believe the economic fragility is genuine, forcing the Fed's hand on rate cuts. This move is convincing investors that lower rates are coming, regardless of political pressure. In this low-volatility environment, smart investors are looking at strategies like curve steepeners. This is a tactical bet that the gap between short-term rates, falling due to Fed cuts, and long-term rates, holding steady or rising due to fiscal excesses, will widen. It's a sophisticated way to make a return when the market is otherwise stuck.
To summarize, the end of the year is a minefield of policy shifts. We have the Fed's pivot to T-bill and chill, the underlying AI asymmetry virtually guaranteeing rate cuts, and the market's low volatility trap. Your strategy must adapt to this complex interwoven reality. Don't miss the next move.
If you found this analysis valuable, hit the subscribe button now and turn on notifications. Your portfolio can't afford to be behind the curve. And let us know in the comments, do you think Jerome Powell will cut by 50 basis points? We read every comment.